Good morning, everybody. My name is Matthew Mims from the Investment Store. On behalf of myself and Devon, I'm delighted to welcome you all to this special US election webinar. So 2006 is proving to be a year of electoral surprises, and we thought that it would be useful to provide some initial thoughts on the possible implications of a Trump White House in general on the economy and also financial markets. And I'm pleased to be joined here today by Devon portfolio managers Slade Robertson, Nick Dravitsky and Tama Willis, and we're also hoping to dial in Bernie Doyle, who I think many of you will know, and Bernie is the lead advisor to the Devon Global Themes Fund. So very quickly, this session will last for about 20 minutes and we'll allow some time at the end for Q&A. As ever, there is a questions box on your screen, so I would encourage you to type in questions as we go along. And also, please note that the content of this presentation is of a generic nature only and should not be deemed to be financial advice to purchase a financial product or security. So without any further ado, I'll now pass you over to Slade.
Thanks very much, Matt, and thanks very much everybody for joining us today. God, it's an amazing time to be involved in the investment markets, and I guess I sat there last night like most of you would have done, watching the way in which the election results were unfolding, and we look at these things and with a number of different hats, don't we? I guess father of a couple of three children, and you sit there and you wonder what kind of future the world will hold for them under the change in government in the US. But then we have to really sit back, and I think this is what this conference call is all about, is demonstrating to you just the need to sit back and take a much more pragmatic approach in trying to estimate and position yourself for what may or may not happen over the next sort of 4 years. And look, it is incredible. When we were sitting there watching the way that markets were bouncing around yesterday, it was a very, very clear risk-off trade every time that you saw progress for the Trump campaign, and vice versa when Hillary won a state or two. And yet today we wake up and we've got the New Zealand market up 3%. So it really is a very uncertain time, and I think people are sort of behaving in a very emotional sort of way at the moment, and we really need to try and cut through that. But Trump is the oldest president that the US has seen. He's a guy that's sort of littered with a range of baggage, right from sort of bankrupt companies, draft dodger. He's got no public office sort of history to him at all. So all these things do conspire to an environment which I think is pretty uncertain for us and for the markets. But look, it is interesting when you look at the way in which markets have historically performed on the back of changes in government. Typically, when you do have a unified government, markets do perform better than otherwise. Albeit when we have seen a change in leadership in the White House, it is normally associated with short-term volatility and negative markets. And so, this is kind of the backdrop that we're working to at the moment. I just want to go through a couple of slides before I hand it through to Nick and to Tama and to Bernie, just to talk to you about the portfolios. But this first chart here just gives you a demonstration of the way in which it played out, and I'm sure that all of you will have seen the success that the Republican Party has enjoyed. And certainly going into this process, it was very much expected that we would see Hillary in office, and that we would see probably the Republicans hold on to certainly the House, maybe not the Senate, but as it's played out, they've had something of a clean sweep. And there is going to be, just got some charts here, just looking at the people that voted for him, and you can see that it was very much, the whites, the men were big participants. Some of the interviews that I'm sure that you've seen, as I have seen, would suggest that the makeup of some of those supporters of Trump weren't people that you would certainly ever aspire to. And it is easy to sit there and say, that the Americans were challenged with an IQ test, which they failed. But the reality is, as Matt mentioned at the beginning of this presentation, this has been a year where we've seen just a range of situations demonstrating the populist protest around the sort of current state of affairs. So. Now, what does it mean for markets and for the economics? One of the challenges for us as investors is that there was such a paucity of detail around the policies that Trump had during his campaign, and so there is still quite a bit of guesswork. I was talking with Tama this morning, and he again highlighted the fact that it is. We have got another couple of months before he does take office, so hopefully we will begin to see some more clarity around some of the initiatives and the plans that he has. Some of the things that we do know is that he's looking to engage in a range of quite major infrastructure projects, government spending, that will be taken as a positive for growth. We're looking at big cuts coming through in the corporate tax rate. So currently the corporate tax rate in America is is around sort of 39%. In effect, the effective rate is around 29%, but the expectation is that we will see a cut down to around 15%. So that will be very positive for companies generating their earnings in the American market. There is talk around certain sectors like the banks, for example. It was certainly felt that there would be a lot more regulation under a Clinton-led government, and some of the changes in the tightening of the rules around Volcker that she was talking about putting in place. He is not as aggressive in that respect, so you saw the financials overnight take a big jump. They also jumped on the back of the bond rates, which I'll talk about in a moment as well. Pharmaceuticals and the healthcare space was an area that Clinton was a lot more vocal on around capping drug prices and other areas within that. So there were certain stocks within that sector which performed very well, but any reform to the Obamacare Act or the Affordable Healthcare Act will certainly throw up some challenges to some other participants. But in an overall sense, the healthcare space was a very big beneficiary last night. So these are sort of areas that we are spending a lot of time, I guess, this morning talking about. And looking to position ourselves for. Look, I won't talk too much more around some of the issues we have here, except just to talk about one thing that was of real interest to us, and that was the fact that the bond market behaved in quite an unexpected way. So if you look around the world overnight, bond prices typically outside of the US were actually reasonably stable. We saw a lot of volatility in the long end of the US treasuries, and initially with the outcome coming through with Trump obviously the winner, you saw that flight to safety, which was represented by long bond rates sort of falling and bonds actually rallying. That reversed during the course of the evening, and what we saw was that the US 10-year treasuries were trading at a rate above 2% for the first time since sort of early January of this year. So that was quite a big turnaround overnight. And one of the things that we have to be really, really conscious of when we're talking about portfolios in Australasia over the next little while is that there has been a lot of money which has come to this part of the world looking for a replacement of traditional sources of income, and the high yielding equities that we have in New Zealand, and also to a lesser degree in Australia, has certainly been a big draw card for investors. If we do in fact see a steepening of this curve in a sustainable way, on account of changes to inflation expectations, on account of changes around growth expectations, then it's something that will have an impact on the pricing of equities in this part of the world. Much less so, we think, than in Australia than here. And certainly, Tama will talk a bit more around some of the benefits for banks and around commodities and resource stocks. So we are pretty excited about our ability within this firm to have that alternative to rotate our funds in strategies like Trans-Tasman and Alpha and the Aussie Fund into the Australian market, where we think we will probably get more bang for our buck over the next 12 months. But look, I'll just pass it through to Tama now, who will take you through the Trans-Tasman portfolio, and but first of all talk a bit more about commodities.
Thanks, Slade, and thanks everyone for dialing in today at short notice. I just, in terms of our portfolios, and we obviously went through them yesterday, and as a result of that, we really didn't make any changes to positioning. We always do deep bottom-up analysis and travel to Australia every month and have our ideas in the portfolios, because we have strong conviction on their underlying value. So we don't anticipate making any large changes as a result of this unexpected political development. In terms of commodities, we have neutralised and added to commodities during this year and earlier part of this year, as it started to become evident we were moving into an upgrade cycle, and that's really been exacerbated. If you look at the chart to the left, you see the prices of the dairy index, iron ore, thermal coal, which is also coking coal, which is used in steel production. That's even higher. Oil's actually been the most muted of the commodities so far, and part of the reason we've seen this development already is basically that You've seen a pickup in demand in China because they've been pushing infrastructure investment and fixed asset investment to support GDP growth. And you've also been seeing some quite big supply issues in China as they've tried to restrict production to support domestic pricing. What they did is they over-restricted, and you've seen elevated prices as a result. And in New Zealand, with milk supply down, you've also seen a sharp recovery in pricing. So as we look into next year, the initial reaction would be that any Trump stimulus is going to take some time to play out. Infrastructure investment in the US, it does take a number of years to plan and to execute on any major projects. You can't put shovels in the ground on day one. But it certainly probably creates a more supportive backdrop in the near term, and certainly you've seen that with speculators pushing into some of the metal markets, copper, gold overnight. And if you look at the valuations of BHP and Rio Tinto, if you include some of the spot market pricing in earnings valuations, then obviously you've got some quite large upgrades. So as this plays out, I'd say that sector remains very well supported. We currently have BHP and Rio Tinto reasonable sized positions in both the Australian and TT fund, and we have Horizon, which is a coal transporter across all the portfolios for some time, which remains undervalued, we think, and this is supportive for Horizon too. In terms of the Trans-Tasman fund, I've put most of the top positions there. In terms of the banks, we are neutral to slightly underweight the Australian banks, overweight National Australia Bank and Westpac against CBA and ANZ. We are neutral the resources through BHP and Rio Tinto, and we have a number of consistent high conviction ideas in the portfolio that we've spoken about in the past, like GTN, which is moving into the US, which we're still very excited about. Vista, I think any weaker currency, and it has exposure right across the globe. It's very diversified with 99% of its revenues outside of New Zealand, and we at this stage we are and have positioned overweight Australia, and that just really reflects we've found better ideas in Australia over the last 6 months, so we've moved more of the portfolio into Australia over New Zealand during the last 3 months. In terms of the Australian fund, I'll just jump to slide 9 before I pass over to Nick. Again, fairly similar positioning to Trans-Tasman, but obviously all of the holdings in Australia, apart from 2 dual listed stocks, Vista and small holding in Fletcher Building. Again, in terms of the banks, largely neutral, and good exposure to resources through BHP, Rio and Horizon. But we're still confident in the positions in the fund. Obviously, we could continue to see volatility over the next 3 months. But that could be an opportunity for us to add to positions as we see value.
Thanks, Tama. Good morning, everybody. I'll just reiterate that I'm reluctant to speculate much further on what happens from here, given our lack of specific insight into Trump's policies, and given also Trump's own character. It's very unclear what the relationship between what happens and what he has set up to date and how that will play out. From a portfolio management point of view, we've discussed the risk. We considered a reasonably low probability risk that Trump would win, but we certainly discussed the risk that would happen. And clearly in the aftermath of Brexit and other shocking results this year, whether that be Ireland or Leicester winning the premiership, it's been a year of some surprises, so it was foolish to discount it completely. And the attractive thing about our portfolios is that looking at the risks and following yesterday as it became more likely that Trump was going to win, the quality of our portfolios broadly, there just wasn't much that we wanted to change given the outlook. As with the other funds, both with Alpha and Dividend Yield, as well as Trans-Tasman Australia, we have significant opportunity to be flexible. Alpha in particular has a very high cash weighting. It's currently at 45% of the fund. And given and looking at an outlook of some volatility, that feels like still a reasonably attractive place to be. And as you look through Alpha, some of the specific stocks, and again, it's very difficult to speculate with any degree of certainty, but there are some exposures there that are attractive if some of these themes that people are talking about play out. For example, ResMed has the healthcare exposure in the US, and Horizon is clearly benefiting from the very rapid rise in coal prices, which has underpinned a big rally in coal stocks, and Horizon's exposed as a sort of a derivative of that function. Turning to the dividend yield fund, clearly the most topical thing at the moment is that the move in bond markets overnight was quite significant, very sharp steepening of the curve. What's driving that is unclear, whether or not it is fears of inflation, whether or not it's some kind of flight away from US bonds, but the big question is how sustainable that will be, and if we do see that over a sustained period of time, then clearly there'll be implications for the New Zealand dollar, the Australian dollar, and the yieldier markets of the world. We're looking at the fund again. The most attractive thing is that there is still a very wide spread to bonds from the dividend yield of the local markets to that bond curve, and there is theoretically quite some room for that curve to steepen before that should necessarily affect materially the valuations of some of these stocks. They remain high quality with good outlooks and defensively positioned industries. So in many respects they remain a very attractive investment. So I guess finally there's just a summary slide there where we sum up some views. I guess the key point is that we remain very in an environment of significant uncertainty, and the clear sharp move at the moment that has been that steepening in the yield curve. That does present some attractive possibilities across the markets, particularly in financials, if that is sustained, and there is the potential for, as discussed, US tax cuts to have some stimulus in that economy in the short term. So broadly across our portfolios, we remain pretty comfortable with our current positioning, and feel that we're in a good position where we have funds that are flexible enough to move to take advantage of any volatility, any chances that this volatility may throw up. So thanks very much for your time, and we have had a couple of questions come through, so we'll move on to those.
We'll just very briefly see if we can pass over to Bernie, who I think has a few comments also to add to the discussion. So Bernie, are you there?
Yes, I am. Can you hear me?
Yep, we can hear you. All yours.
Okay, thanks, Matt, and hi, everyone. Look, obviously, really interesting night. From a global perspective, reiterate what the other guys have said, in that very early days. I mean, it was fascinating watching market futures last night, predicting a 700-point sell-off in the Dow, and then as soon as Trump started speaking, you could see all of these markets, dollar yen, S&P futures start to rally, and it just emphasises to me we don't really know what to expect from this guy, and so there will be a huge focus on what he says, because rightly or wrongly, I think most people would agree, the debate ahead of the election was really not a policy debate, it was a personality debate, so now we need to fill the vacuum. All that said, I do think there is some pretty clear macro signals from some of the early price action, and in particular the bond market has sold off quite a way overnight, as Slade mentioned. And look, I think we'll know in the passage of time, but my view is that's probably justified, given that one very clear mandate from Trump is he wants to cut taxes, which should enjoy support from the Republican Party, and he also wants to spend on infrastructure, which again, certainly in the honeymoon phase, I would have thought does enjoy some popular support from House and Senate. And therefore, whatever else is going on, the idea that austerity or fixing up government finances is still a fashionable thing to do took a big hit last night, and therefore as a bond investor you should be mindful that this could be a change. I would have loved to have been a fly on the wall in Janet Yellen's living room or wherever she was watching the election, because I think this puts the Fed in a really interesting situation, and I think you could find bond investors start to sniff out the possibility that the Fed is way behind the curve if Trump does get his wish and really pursues a very reflationary agenda. So that that's an area to watch. And just given the price action, that's where some of the most interesting debates will be played out at the sector level. So you saw overnight, banks have rallied hard, utilities have sold off. The two most bond-sensitive sectors in the market have gone their separate ways because of the big move in bond yields that we've seen. The other thing I'd say, just in terms of, whilst this does break open some interesting sector ideas, I would separate what I'd call the honeymoon trades from the real, the true ideas. And a classic honeymoon idea is, well, he's going to spend a lot, so I'll buy Caterpillar, and lo and behold, Caterpillar's up almost 8% overnight. Infrastructure and making money from infrastructure spending is tricky. And takes time, and I'd be a little cynical that that's not more than baked in some of the price reactions from from some of those infrastructure exposures we'll see. Flip side is, I do think some of the financial implications, i.e. reflation, slightly higher growth maybe, does have implications for structural implications for bond yields, given our very low starting point, where bonds, as of a day ago, were trading in line with printed inflation. So I see that having some way to run, and that for us is a real area of interest. Geopolitics, really to reinforce what everyone else has said, I think, God knows, but you do know that if you didn't place some sort of premium on geopolitical risk pre-Trump, you probably should now. So as a global investor, investing in some of the ASEAN countries and countries that may be in the path of a multipolar world where Russia and China feel room to be more assertive, these really are areas to keep a close eye on, I think, as is emerging markets generally. Emerging markets may welcome a free spending president. They probably won't welcome a strong move upwards in bond yields. And then finally, I'll just finish on our portfolio position in the Global Themes Fund. We carried a little extra cash. We're, into the election, we were 15% cash. Our biggest fear was a contested result. Thank goodness we avoided that. At some stages yesterday, it looks like that's where we were heading, but we've avoided it. So really, our attitude is to, sift through some of these new ideas quickly and get the portfolio back to work. I think, thankfully, we really are, pretty well positioned for the post-Trump or the Trump world, in that we already have significant exposure to US banks, and we have almost no exposure to bond proxies in the portfolio. So, if that is, this reflationary trade really continues to roll on, as I think it might, we should benefit via our existing tilts into financials, and, as I say, avoiding the likes of the utilities, consumer staples at the global level. Areas of interest, one really interesting area is, and that hasn't rallied particularly after the result, is technology, I think. These companies own around about 15% of their market capitalisation in cash held offshore. One of the things Trump's committed to do is have some sort of incentive for these, the Apples of the world to bring their cash home. And again, with Republican House and Senate, should be able to manage that, and that could be quite a significant positive for those companies that have significant cash hoards in offshore domiciles. The other area we'll be watching closely is healthcare. What does a repeal of ACA really mean? How far do they go down trying to unpick that? And what does it mean for the pharmaceuticals and the medical devices? My gut feel so far is let's watch and wait, but the basic thematic of healthcare, I think, is still very much intact, and you can try and get too cute with the political environment. We're still looking at a world that wants and needs cures and devices, and I think that's an important backdrop. But it obviously will be very interesting to see the permutations from here around what a Republican clean sweep means for the healthcare industry in the States. Matt, I'll finish there, and very happy to join in with questions.
Thanks very much, Bernie. So just a question on free trade. There's already been intimation that the TPPA is redundant. I just wondered if anybody could comment on that, and also in respect of the implications for financial markets. Bernie?
Yeah, sure. I mean, I think obviously it's, I don't think this is a great outcome for New Zealand being a trading nation. Thematically, I think John Key's already come out and said TPP is probably on the back burner. The things to watch, with Trump again, after the lock her up chance, his first words out of as president-elect were really to heap praise on Hillary Clinton. So what we'll all be hanging on is, after saying I'm going to slap a currency manipulation charge on China and punitive tariffs, what will the real Trump do? I don't think there really is any winner out of a trade war with China, and there would be a lot of collateral damage. So we're kind of on tenterhooks just to see how that particular debate or agenda plays out. Rightly or wrongly, I would say markets have taken some hope from the fact that, as I say, Trump's first words as president-elect were to roll back some of his more extreme campaign rhetoric, and so we'll just have to see whether that how far the pragmatist emerges from a candidate that appeared to be quite extreme.
Okay, listen, thanks very much, Bernie. I think we'll end it there. We've used up our allotted time. So just a quick thank you to all our presenters today for taking the time to prepare the material, and thank you all also for dialing in. We hope you found it interesting and enjoyable. We will do a follow-up note and send you through a recording of the presentation. But on that note, thanks very much and have a good day.